In our recent investment outlook piece, we highlighted that the global economic growth outlook has improved and global equities have done well in the first quarter. Economic growth in the US is strong and the outlook has gotten even more positive. This is also reflected in the Fed significantly upgrading their GDP growth forecast for this year and projecting unemployment to remain low for the remaining of this year, and that inflation is within control. Despite the strong economy, the Fed has maintained a dovish stance with 3 rate cuts projected for this year. Things are also turning more positive in Europe. Both the composite PMI and the ZEW economic surveys indicate improving business sentiments, which suggests that the European economy is starting to recover. The European Central Bank is also expected to cut interest rates following the Fed. The Japanese government is also confident that Japan has finally exited deflation, and the Bank of Japan ended its negative interest rates policy in March. This move is considered dovish, as the Bank of Japan has not indicated further interest rate hikes to normalize monetary policies. In China, recent economic data remains mixed, and remains to be seen if China's growth could accelerate. The National People's Congress has set a growth target of around 5% for this year. This is viewed by many as being optimistic, and a sustained recovery would likely require even more aggressive stimulus, especially for the property sector, which remains a headwind to growth. This combination of a soft landing scenario and interest rate cuts in the US is positive for risk assets. The risk, however, is that the positive backdrop could already be priced in certain markets such as US equities. Fundamentals are still supportive for US equities, and there are signs that the market rally is broadening beyond large cap stocks. But investor positions are stretched and valuations high. The upcoming presidential election could also introduce greater policy uncertainties, which could mean greater volatility for the US equities market. We think there are greater opportunities in the Asian equities markets. Generally, the macro backdrop of peak US interest rates, a potentially weaker US dollar, and recovering Asian export volumes on the back of an inventory replacement cycle is positive for Asia equities. We are positive on Taiwan and Korea equities as beneficiaries from the artificial intelligence investment cycle. Korean equities market is also supported by improving shareholders' returns from their Value Up program. Indonesia equities will continue to benefit from the commodity Value Up upcycle, and India equities are looking more attractive after recent corrections following regulatory moves to curb speculative excesses. For bonds, we are positive on longer duration investment grade bonds. The key risks to our views are an unexpected rise in inflation, policy mistakes in China, and geopolitical risks, as it could lead to higher oil prices and therefore higher inflation.